Hello everyone. If you saw our recent short on why you should always be double checking your paycheck, then you know that employee paychecks often have errors, and those errors could be costing you thousands of dollars. If you haven't seen that short, go back to our channel and check it out. But you asked for the more detailed version of how you should be double checking your paycheck, and that's what we're here to deliver today. So in order to do that, we're going to walk through this illustrative paycheck that we've created for John Smith. We'll walk through two categories. First, gross to net pay, which takes into account all of the imposed government taxes that you have to pay, because we all have to pay Uncle Sam. Then we'll walk through all of the opt-in deductions, both pre and post-tax. Again, there are so many places where these errors can occur, so the best way to be able to combat errors is to actually know and understand what the pay should be. So let's start with your gross pay, which is section C of the paycheck that you see on the screen. Most workers are either hourly or salaried. If you're salary, you want to make sure that the rate that you're receiving on your paycheck is correct based on your original offer, raises, or promotions. Sometimes people have difficulty calculating the actual rate that they should be receiving because a lot of the natural thing to do is to take that yearly number, divide it by 12, and then divide it by 4 because most months have 4 weeks in them. But the key here is to actually get precise. And so what you actually want to do is to take that annualized number and divide it by 52 weeks in the year, and then multiply by the number of weeks in your pay period, which is 2 for most people. If you're hourly, you want to double check that both the hourly rate and the number of hours worked actually matches reality, which is one of the bigger places where there tend to be errors in paychecks. This is especially critical if you've had overtime worked in the pay period. You'll want to make sure that it reflects the accurate number of hours and that the rate was appropriately increased, typically 1.5 for overtime, to reflect the extra pay that you should be receiving. Okay, so once we feel comfortable that the gross pay is correct, let's now move on to taxes, which are often complex and can trip people up. While most people do understand that tax brackets exist, it sometimes can trip people up in terms of how you actually calculate your would-be tax. We're going to use a tax schedule for a single filer here for simplicity. So now let's say you make $110,000 a year. So what you can see from the schedule on the screen is that anyone making above 103,351, your final tax bracket is 24%. Now, where this tends to confuse people, that does not mean that the entirety of your $110,000 is going to be taxed at 24%. It actually means that you're going to graduate through each of the steps on the schedule for each of those income bands. It's going to be kind of complicated, so bear with me while we walk through this. So for the first $11,925 that you make, that's going to be taxed at 10%. So the tax on that portion will be $1,192. So for the money that you make that's above $11,925, but below $48,475, that's going to be taxed at 12%. So $43,886. So for the dollars that you make above $48,475, but below $103,350, that's going to be taxed at 22%. So this is the first time we see a rather large jump in the bands. So the tax for that band will be $12,072. And lastly, for the individual who we're building this example on, who makes $110K per year, for the dollars that he or she makes above $103,350, those are going to be taxed at 24%. So the tax in this band is going to be $1,596. So if we sum that up across all of these bands on the table, for an individual making $110K, their annualized tax should be $19,247 if they're a single filer. And this means that the effective tax rate will actually be 17%, not the final band of 24% that we saw on the table. Now, if you don't want to do that complicated math, no problem. We've also linked the IRS tax tables for 2025 in the description below. And for that one, you can look up your actual annualized income and it will tell you your tax for the year, but the caveat that it only goes up to 100K. So for each paycheck that you receive, which is a regular paycheck and not a bonus, which is taxed separately, what the government will be trying to do is annualize that number and understand if you were to continue to get paid at this rate for the rest of the year, how much would you be owing in taxes? And that is how they're calculating what they should take out for that particular paycheck. Now, if you look at the section in the upper corner, what you'll see is the tax data, which represents the number of allowances that John Smith has elected. And this is relevant because what the government is trying to do is get as close as possible to your actual real tax rate, which will account for the number of withholdings or allowances that you have. And will also include how you plan to file, married or single, and the number of dependents that you have. Getting this wrong could mean that they're taking too little out of each paycheck, which will mean you'll have a lot to pay at the end of the year during tax season, which people don't like, or they're taking too much, which means that you'll get a large refund, which seems good on the surface, but just means that you've been giving the government an interest-free loan and you should be collecting your money throughout the year. So it's important that you check your rate throughout the year to ensure that it seems appropriate and adjust if anything seems off. Now into state taxes. For many states, this is calculated as a flat rate of AGI, adjusted gross income. For Illinois, that rate is 4.95%, but you can easily find for your particular state, like whatever rate it is online. Lastly, on to Medicare and Social Security. Now for Medicare, it's simple. It's a flat rate of 1.45% for earners with an additional 0.9% added for high earners, which is defined as $200K for a single filer and $250K for a married filer filing jointly. For Social Security, it's also a flat rate of 6.2% for earners, but this one maxes out at the income level of $184,500, meaning that once you hit that threshold, you no longer have to pay Social Security taxes for the rest of the year. So once you factor in each of these categories, federal and state taxes, Social Security, and Medicare, you get your net pay, your gross pay, less the required government deductions. Now, the story doesn't end there for your paycheck, so John is going to walk us through the rest.